Welcome to the Titans of Industry show. I'm hosting Andrei Polgar, an economist and author who creates short videos on his YouTube channel which center on understanding the fiat monetary system and much more. And his new book, The Age of Anomaly, is basically another way of saying that we live in unprecedented times, in times of realities that we must accept instead of reject or protest. But these are very unusual times, as he says. Andrei, thanks for joining us today.
Thank you for having me, and thank you guys for listening.
Hey, we're going to have a great session with you, and I want to jump right into the first subject, which is anomalies. You talk about anomalies. The book is about anomalies. The U.S. is going to face a major burden of unfunded liabilities, which have to do mostly with its retiree population. Has your research been able to point out how problematic this situation really is?
Well, it's definitely very problematic, and not just in the U.S., but I'd say in the Western world in general, so to speak. We have the same problem here, problems here in Europe. Let's not even talk about Japan, where 1 out of 3 young people is declaring that he chooses to live in celibacy, and that leads to the demographic nightmare they're facing right now. So yeah, everywhere in the civilized, if you will, world, it's a huge deal, and it's a huge problem in and of itself. But if you also think about the bigger picture and how this particular problem has to be dealt with in the context of, in Japan, for example, not only do you have this huge demographic problem, but you also have a debt to GDP ratio of over 200%. Not only that, but you have also an economic system that's hooked on continuous stimulus. So even taken in isolation, each of these things is a major cause for concern. I've chosen the title, The Age of Anomaly, for my book precisely because these things taken together form a picture that I think we need to be paying more attention to. I'm talking to people now when everything's calm. It's always an easier sell for a book like mine if you talk to people about it when everyone's panicking. But I prefer to talk to people about these things ahead of time, primarily because it takes time to position yourself accordingly, precisely because, in the U.S., the demographic issue, for example, is a major deal. So is the debt burden. So is the nature of the economic system and, its dependency on the unsustainable. All of these things combined should give you goosebumps, and that's kind of that's kind of been my goal in the past couple of months, trying to the best of my ability to raise awareness about this stuff.
Now, I want to ask you this. The word economy comes from the Greek language. What else, right? Oikos means house, and nemo means allocation. Basically saying that economists deal with the management and disbursement, the right allocation of wealth, inside of the family cell or inside of a society or wherever else. It's how to distribute wealth in the right way. Basically, that's what an economist originally does. But Warren Buffett said that any company which employs an economist has one employee too many. Basically, citing that today's economists, all they do is try to forecast the future, and he loves to say that forecasting tells you more about the forecaster than about the future. And I was very fascinated by your own remarks in previous interviews that you've done, that you don't claim to know what's coming, but you do know the surroundings of where we are, the environment, where the pendulum is right now, and that ties into my favorite investment book by Howard Marks, called the most important thing illuminated, and where he talks about the fact that you don't need to know, you can't precisely know how to time the market, but you can have a general idea of where an industry is, where an economy is, where everything is, and then you can manage a portfolio this way. You know if you're in a bear market or in a bull market. Anyways, with your own perspective, if you can go into specifics when it comes to portfolio management, what can you offer the listeners today?
Well, for starters, I think Warren Buffett is spot on, or you have other people. You have, I think, Reagan, who said if he asks his three economic advisors a question, he's going to get four answers. And then you also have, of course, I think the most eloquent way of putting it is Nassim's Taleb way of seeing reality. And I think the answer to your question revolves around three words. Once again, I'm going to quote Taleb on it and say, you need to have skin in the game, in my opinion, and that's the number one thing. Because at the very beginning of his book, of his most recent book, what was it, 2018, which is actually called Skin in the Game. He gives the example, of this very strong creature, the child of Mother Earth and Poseidon, the ruler of the seas, who has this amazing strength, but Hercules, in a battle against him, managed to exploit his one major weakness, that when his feet are not firm on the ground, so when he loses contact with his mother, basically, he becomes weak. And the same principle, in my view, is valid when it comes to knowledge in the realm of economics. Once knowledge is no longer connected to the ground, is no longer connected to reality, and unfortunately this is happening a lot, we have a problem. And yeah, what I bring to the table, I feel, is a dose of skin in the game that I think people are going to find reassuring, because I write books, I publish videos from a position of relative financial security. Like, I do okay in real estate. I've made a small fortune trading crypto. I keep my ear to the ground. And by being someone who kind of puts forth a decent combination between street smarts and book smarts, I think my arguments are a bit more compelling, because I think Taleb and others like him are spot on when criticizing people who, talk about policy, talk about what should be done, but when you ask them, okay, what exactly have you done in your career? Oh, yeah, they're only going to quote you, stuff that has to do with one dimension, book smarts. So, and this ties in, I feel, very well to another thing you've mentioned, which is the fact that economists need to understand their limitations. I mean, right from the 19th century, you had economists like Leon Walras, who thought that no, I can see the interdependence of the entire system as a set of equations, and I can solve them, and the answer is 7. It's something economists have wanted to do for a very long time. And while there's nothing wrong in trying to bring more of the things that have to do with natural sciences in the study of economics, you do need to understand that there are limitations. And actually, my main mantra, my main MO as an economist is just that. I tell people to embrace their incompetence when it comes to predicting the future, to make it a core pillar of their strategy, because it would be the easiest thing for me to kind of come in front of you guys today and say, yeah, we're going to have major hyperinflation, and therefore I think you should invest in this and that. It would be the easiest thing in the world for me to have a working crystal ball, because it would tell me what's going to happen, and therefore I only need to prepare for that one scenario. But the thing is, I don't know. Maybe we're going to have very strong deflation for an extended period of time. Maybe we're going to have deflation followed by a loss of control that leads to inflation. Maybe something else is going to occur. And I think the humility it takes to understand that you cannot predict the future in and of itself is going to put you many orders of magnitude in better shape than the average consumer. And that's what I try to do in the book. I don't believe in spoon-feeding people a precise strategy, primarily because people are buying my books from, all over the world, from Australia, from Kenya, I've even had animations that appeared on TV in Kenya. They appeared in Holland. They appeared all over the place. So the idea of kind of pitching one-size-fits-all solutions is just foolish. In my book, when it comes to my MO in general, I take things one step at a time, and I tell people, 1, know your economic history. Not because history repeats itself, but it does rhyme, and it gives you a proper understanding of human nature. This human nature is going to give you clarity, and this clarity coupled with number two, a willingness to stay informed, to gather information from mainstream media sources, from alternative media sources, from people you love, from people you hate, equally important. These two combined are going to make you, put you in a good position to have your ear to the ground. And finally, three, what I do in the rest of the book is simply take things one asset class at a time and tell people, look, here are the pros, here are the cons, here's what my experience when it comes to the asset class in question is, if applicable, and here's how to decide whether or not it's a good solution for you and how much exposure you should have. So essentially, it's not something that involves rocket science, but most people don't do it because they have to put in the work. And in my books, on my YouTube channel, when I'm covering such topics, I always make it clear that I'm not in the business of selling dreams. I'm not in the business of selling the equivalent when it comes to economics to weight loss pills that are going to help you become a supermodel overnight. No, you have to put in the work. I'm going to give you everything you need at your disposal in terms of tools, in terms of context and whatever to make those decisions, but it's on you. It's not something you should outsource to me. It's not something you should outsource to Buffett. It's on you to make these decisions because you live with yourself 24/7, and I can't think of anyone who's in a better position to make those choices.
Now, let's talk about today's economic system and the way that it's structured. Do you think that the current system favors some people, some populations, some demographic groups over others?
Of course it does. Of course it does. Because once again, it's important for economists to kind of be anchored to reality. And reality, what is reality? Well, your friends, your family members, your acquaintances, your business partners. How many people, when it comes to the average Joe, do you personally know who have an amazing portfolio, who are well diversified, who have been able to take advantage of the massive asset appreciation that has taken place over since the Great Recession? Not that many. And actually, this kind of brings us to the conclusion that the main beneficiaries have been those who were wealthy to begin with. So what happened, and to me it's pretty obvious, what happened is that the financial system has essentially, if you want to call it that, it has essentially been zombified, and that we've made it dependent on stimulus, on low interest rates and so on, to the detriment of the average person who is not financially sophisticated enough to have exposure to assets which have done well. And yeah, essentially that is what happened. We've turned our financial system into one where the unprecedented is accepted as status quo. Like from 1913 up until the Great Recession, you had $800 billion or so in the monetary system. In the US at the height of QE, 85 billion per month were pumped into the system, $1 trillion per year, more than had accumulated in almost 100 years. But we've come to accept this, unprecedented state of affairs as status quo, the same way we've come to accept a debt to GDP ratio of roughly 100% when it comes to most developed nations as something normal. And hey, even when it comes to Japan with their debt to GDP ratio of over 200%, we have come to accept that as well. Who has benefited from this? Those who were either financially well off enough or financially sophisticated enough to have exposure to the assets that have done well. Who has not benefited from it? Well, pretty much everyone else. And, when it comes to the end game, when the entire thing, when it's time to pay the bill, it's kind of like one of those situations where, it's capitalism when it comes to profits and sharing them among the winners. But when it comes to the losses, those are going to be socialized, and we're all going to have to chip in, just as has happened multiple times throughout history. So one of my main driving forces when it comes to promoting the book and being on so many interviews and shows and kind of telling people, anyone who cares to listen about this stuff, is primarily this, because more likely than not, the average person is not going to be on the receiving end of the major transfer of wealth that I envision. And, to the best of my ability, I'm just trying to reach as many minds as possible and possibly plant some seeds that are going to turn into something good.
One of the things I love about the some of Trump's quotes is that they asked him a few years ago, well before he was even a candidate, and I haven't heard him say anything about presidency at that time. He was just asked about business, and they asked him, what is your best advice for the average person? And he says, my best advice is for the average person is to not be average. But let's move on. Let me ask you something. Can you point to some of the concerns that you have today with regards to the economy?
Of course, there are many pockets of anomaly that I see, and once again, taken individually, each is a major cause for concern, and collectively, let's not even go there. So, one, you have the fact that our system has become increasingly dependent on the unsustainable. Things didn't look so bleak when it comes to the dot-com bubble that occurred several years ago. You had the dot-com bubble, you had a major crash, people panicked, but, interest rates were reasonably high. You brought them down to 1%, which was unprecedented, but at least by the time the Great Recession hit, they got a chance to climb back up, not to their previous levels, but close enough. They climbed up to like 5.5% or something like that. Not bad. Then the Great Recession came along. Once again, people panicked. Oh my God, the sky is falling, but don't worry. Central banks and governments have it under control. That was the narrative once again. But lowering interest rates to 1% was no longer enough. They had to be lowered to zero, negative in the EU. 85 billion, as mentioned previously, per month had to be pumped into the system in the US, even more at the height of QE over here in the European Union. And yeah, fast forward, here we are today, asking ourselves, what would happen in the event of another crash? Now, unfortunately, interest rates, as I'm sure people have noticed, are not at 5.5% in the US, for example. So that's one. Two, even if they were, more likely than not, kind of like a drug addict, to make a popular analogy, the system is going to demand a bigger dose of stimulus. So it's not going to be enough to lower them to zero or to their previous levels in the EU. Let's say they're lowered to negative 1%, and let's say 3 trillion or 4 are quote unquote printed instead of 1 per year. If the market accepts it, then everything is just fine and dandy, and we're good to go for another round, for another business cycle, and then when the next recession hits, we'll see what happens next. But what if that changes? So the main pocket of anomaly I see is the fact that, there's just not as much room as people think to continue kicking the can down the road. Because one of my most popular videos on 1 Minute Economics is one where in a minute I explain fractional reserve banking. So it's not like people can lower interest rates to negative 50%. That's not going to happen. You have far less wiggle room than most people realize at this point. And yeah, I consider this dimension, our system that has become hooked on this, economic stimulus, on all of this that has, on status quo economics, if you will, that's a major pocket of anomaly right there. Number two, we have, of course, the political situation. And you cannot possibly study history without noticing, some patterns. When things are bad, countries want to help their domestic companies. They want to boost exports. They want to devalue their currency. Next, they want to take things one step further, and they impose all sorts of tariffs. And it's great. Hey, if you're the only one imposing them, it's going to be fine. But you're not going to be the only one. Other countries are going to retaliate. That leads to a trade war. And it's only a matter of time until something worse happens. So if people are not seeing similarities in the present to what I've just said, then they're not paying attention enough. Currency wars have already occurred. That ship has sailed. Now countries are taking it one step further. More and more movements are appearing in countries. Hey, let's protect our industry. Let's impose tariffs so that our companies are better off. And of course, then you're going to have the exact symmetric thing happen in other nations as well, which leads to a political situation that, historically speaking, did not end well. Of course, past performance is never indicative of future results. I'm not saying there's 0% chance of things being different this time. I'm just saying that they probably won't. So there's this dimension. Dimension number 3 that is equally important. Just look at how many economists since the Great Recession have come forth on mainstream media, on alternative media, and made prediction after prediction after prediction after prediction, and they didn't pan out. So what happened? After so many failed predictions, the average person, to put it mildly, tends to raise an eyebrow whenever they hear an economist talk about warning signals. So not only are there quite a few pockets of anomaly that are extremely problematic and are going to lead to a perfect storm type situation, it's going to be an even better, or if you will, even worse storm if we also take into account the fact that the very idea of financial preparedness has been turned into a joke by many economists who don't properly understand their role. They insist on making prediction after prediction, and that led to people losing faith in the very principle of being financially prepared. So yeah, I think these three are a decent enough starting point and more than enough reason for people to kind of say, okay, let's move on from just talking about these things to, positioning myself. Because again, I have to stress this. It's one thing that we're having this conversation, but if this conversation doesn't lead to action being taken by those who are listening, then it's just mental masturbation in a sea of even more mental masturbation. People have to take action. People have to do something, and it takes time. It took me years to build decent exposure in the real estate sector. It's going to be easier to do it with equities or with precious metals or with crypto or with other assets, but still, putting together a balanced portfolio, one that maximizes the likelihood that you land on your feet, it's no small feat. It's something that's going to take quite a bit of time. And therefore, the best time to do it would have been yesterday, but that's what I try to stress in all of the conversations I have with people nowadays. If you who are listening right now don't take some sort of meaningful action as a result of watching, or actually listening to us, then it's all in vain, essentially.
Now, I want to ask you, Andrei, do you think the stock market right now as a whole is in a bubble? Is it overvalued? Are buyers being euphoric and making poor choices? Or, in other words, was this a correction that we're experiencing right now? Or was this the top? Was the top in January or February this year? And where are we with the stock market in your opinion? And how are you investing in light of that?
Well, let me put it this way, and at first it's going to baffle people, but there's method to my madness, so hear me out. Is the stock market overvalued at this point? Are valuations in some cases ridiculous? Yes, they are. Is in many places of the world the real estate market overvalued? It most definitely is. Am I there? And not only that, but as a person who talks about financial calamities and so on, this is what baffles people because they expect me to automatically be bearish, to be pessimistic on real estate, on stocks, and so on. But I am not necessarily pessimistic, and I will tell people why. The easiest way to explain this is when it comes to real estate, but the same principle is valid when it comes to stocks. I'm someone who even trades crypto. I have nothing against volatility. I've come to understand volatility, to accept volatility, and I'm not easily spooked by it. So I am definitely not spending so much time writing books, being on interviews and so on, just to tell people that I'm afraid of a market crash. No. I'm not afraid of your average business cycle. I'm not afraid of market crashes. No. I'm afraid of scenarios where a market crash leads to a loss of control. And therein lies what people I think need to understand about my position. If this is going to be yet another classic market crash, like, okay, yeah, prices went overboard, then they're going to crash, and then they're going to recover once again, and then it's going to be an economic recovery once again, then yeah, of course. But what happens if prices are high, we're going to have a crash, we're going to have an attempted economic recovery, but unfortunately this time it's going to result in a loss of control by governments and central banks. Because the elephant in the room, and everyone who doesn't understand this, is they're deluding themselves. The elephant in the room is not the stock market. It's not the real estate market. It is people's confidence in the ability of governments and central banks to keep things under control. If that confidence is lost, all bets are off, and all assets that are not directly tied, that are not directly tied to governments and central banks will be seen as potential hedges, as potential safe havens, be they stocks, real estate, crypto, or something else. So in this scenario, the most dangerous one, in my view, what I tell people is this. If you think your timing can be impeccable, then by all means, sell before the crash, buy back in after the crash, but be careful with your timing, because if you decide to buy back in after the loss of control already occurred, tough luck, you're not going to be in a good position. So that's why my position is far more nuanced than people would have expected it to be. And because it's quite an assumption for you to believe that in this kind of a dramatic market environment, you're going to pull off the timing perfectly. Now, again, I'm someone who trades actively, but when it comes to my overall protection strategy, I don't go by that assumption. So personally, when it comes to real estate, for example, do I consider prices here in Romania a bargain? No, I do not. But at the same time, I'm not selling what I have. The same principle is valid when it comes to the robust part of your portfolio, the assets you believe in, the assets that you definitely think are not likely to disappear overnight. And for most people, again, I think this kind of a strategy would be recommended. A strategy which does not revolve around you having impeccable timing. Because when you're sipping your coffee and thinking about how amazing your timing is going to be, that's one thing. But when you have to kind of deal with the reality of the investing world, you're going to notice that when it comes to most people, their timing is way off. It's a common misconception among investors. The assumption that, oh yeah, that particular trader lost money because he was wrong. No, a lot of traders are right, and that what they envision happening ends up happening, but they lose money because their timing was off. So therefore, from the perspective of the average person, from the perspective of someone who wants to build a robust portfolio so as to protect him or herself, I think this scenario needs to be understood. As afraid of you are as a crash, and as much as it sucks to see, the value of an asset going down temporarily, I do have to stress that you're making a major mistake, in my view, if you're not preparing for a scenario which revolves around a crash, an attempted recovery, and then an ultimate loss of control. Can I promise that it's going to happen this way when it comes to this particular business cycle? No, I cannot. But the name of the game is landing on your feet. So yeah, when it comes to this particular dimension, that's just my 2 cents.
So, Andrei, last question. Where can people check out your work and perhaps your books?
People can find me on youtube.com/1 Minute Economics, or they can just search for 1 Minute Economics on on Google, sorry. When it comes to my books, my first one is called Wealth Management 2.0, and it's basically the only personal finance book out there written specifically for people who make money online in one way or another, freelancers, online entrepreneurs, and so on. It's written by an economist, yours truly, who has also been earning a living online since pretty much forever. So I think, once again, it's a very good balance between book smarts and street smarts. My second and most recent book, which is called The Age of Anomaly, can be found, just like the other one, everywhere books are sold, on Amazon, Barnes & Noble, Kobo, iBooks, and it's basically kind of like a no-nonsense approach to being financially prepared. I don't cut any corners. When I write books, I don't write magazine articles. I don't write, my books are huge, but I do my best to make them conversational. They're research-backed books, they're huge books, but they're books which I hope people are going to find pleasant to read. So, yeah, 1 Minute Economics, Wealth Management 2.0, The Age of Anomaly. Just search for any of those on Google and you're going to.
Any website also to let people know about?
Yeah, sure. I have 1minuteeconomics.com, wealthmanagement2.com, ageofanomaly.com if they just need some quick links to buy the books, or they can just search for it on Google. I'm a very easy guy to find.
Andrei, thank you very much for taking the time.
Thank you for having me. Have a great day.